Good afternoon, everybody. We have an interesting topic with David Korman this afternoon, which is unused housing tax. It is something that is an additional advantage to yourself and to your clients. So I would, I'm an amazing session. We haven't, David, I don't think we've ever presented this topic before. So I'm really looking forward to you shedding light on this and us learning a lot more today.
Well, thanks, Sabiha, and thanks everybody. Good afternoon. Thanks for joining us on this session. Now, I don't disagree with Sabiha on too many things. We agree on almost everything, but I'm going to disagree on this thing. I don't think this is such an interesting topic. This one actually pisses me off, for lack of a better term. It's a brand new tax, and it's putting everybody to a great deal of anxiety to decide whether or not they have to file something to comply with this tax and whether it's payable or not payable. And I just don't understand the rationale personally as a Canadian citizen why this was imposed. But anyway, that's my semi-political commentary for this. And having said that, I'm happy to be here to take you through it to the extent that I can. Now I got to give you my lawyer's cautionary proviso. I'm not a tax expert. I don't hold myself out to be a tax lawyer. I'm not a tax lawyer. As you all know, I'm a real estate lawyer. And but as a real estate lawyer, we have to have some understanding, some basic understanding of these types of things that come up in these issues. And this is no exception. But what I'll tell all of you, and I'll probably say this a couple more times during this webinar, is that this is really something that the accountants should be looking at on your behalf if it affects you, or on your client's behalf. It's the accountants, the tax advisors that are going to be doing the filing and paying these taxes, or helping you or your clients pay this tax if you're subject to the tax. So I just wanted to make that clear up front, but I'll take
and that should be clear for the realtors too, that the webinars that we produce, it's not for you guys to become specialists and start giving advice, but at least just know the tip of the iceberg, and so kind of have some direction when clients do speak to you about it, because that's what happens, right? Like, all the questions come through us and they're filtered, and then we go ahead and introduce the right professionals to help our clients out. But so this is just basically to acclimatize ourselves with what's going on.
Exactly. And see, once again, I agree with Sabiha. Like, most of the time I agree with Sabiha, and that's exactly right. So anyways, I'm going to take you through this, and I'm going to tell you something else, like right off the bat. You're going to find this a little bit confusing, and that's just the way laws are drafted sometimes, and the way they're defined and everything. And as hard as I can to try and simplify this, I will, and in the presentation, and I'm just skipping through our introductory stuff because most of you are familiar with our office, and reach out anytime through any means, and privately, or we're going to do a chat at the end of this if you have any questions or something. I'm happy to stick around. Otherwise, try and reach out privately. Make sure you're tuning into David and Real Estate. We just finished recording an episode a couple hours ago. It was me and Sabiha, special guest, Sabiha, special co-host, and on pre-construction, new construction. So that'll probably be available early next week, I'm guessing. So tune in to any of the episodes of David on real estate if you haven't been, and follow us wherever you can. So by way of introduction on this topic, this is first of all, it's a federal act. Okay, this is the federal government, the federal Liberal government. Prime Minister Trudeau introduced this back in December 2021. Okay, so the reason so many of you probably don't know about this, and a lot of people are scrambling right now, even though it was introduced right then, and then it received assent back in June 2022, like almost a year ago, it came into effect actually on January 1st, 2022, not 2023. So it came into law then, but like everything you do, when we file our tax returns or our normal income tax returns for the calendar year 2022, we're filing by April 30th of 2023. So this is no different. This legislation came in effect to affect us in 2022, but you have to file if you and pay the tax if it's payable by the end of April 2023, which is why people are now scrambling to say, hey, what is this underused housing tax? And do I have to pay anything? Do I have to file something? It's almost April 30th, which is why we wanted to get this topic in, even though it's already April 17th. So you've got 13 days to get this done. So go to it. So normally that's what I'd be telling you, but I'm going to tell you something that you should pay attention to because it's not in the slides. I'm going to be showing to you, but a few days ago, maybe it was a week ago, the government announced that even though everybody was supposed to file this by April 30, 2023, 13 days from now, because there's been so much confusion in the public and even amongst accountants, tax advisors on this and what they have to do and how they have to fill out the forms and who has to file and what they have to file, that the government just announced that they're going to allow everybody to file at the end of October of this year instead of April 30th without interest or penalties. So everybody can take a big deep breath and relax a little bit because you don't have to get off this webinar and contact your accountant immediately, although you probably should, but your accountant should know also by now that this does not have to be done by the end of April, 13 days from now, because the government just gave a 6-month extension on this because everybody was panicking a little bit about this. So put that in your back pocket, breathe a little more deeply, because some of you will have to file. Some of your clients will have to file, and some of you may have to pay the tax. Your clients may have to pay the tax. So we're going to go through that. Okay. So anyways, just like any other income tax filing, you're filing in April 2023 for what happened last year for the year ending December 31, 2022. It's okay. So there's nothing really unusual about that. Okay. So what is this underused housing tax? So this is something that's going to be done annually. Okay, it's an annual filing. It's something you have to consider every year when you're filing your tax returns. And it's a tax that's supposed to be paid on vacant or underused housing in Canada. And we're going to get into all the definitions of what's considered underused housing and vacant, etc. Okay, and typically they're targeting for this to be payable by non-resident, non-Canadian owners of vacant or underused housing. So the majority of Canadian owners of residential property are excluded because there's a bunch of exclusions and therefore don't have any obligation under the Underused Housing Tax Act. But that's they don't have any tax obligation. They may not have to pay tax, but they may still have to file something with their tax returns to show that they don't have to pay the tax. And in some situations, it is payable by certain Canadian owners. So if you're not confused already, I'm going to get there. You're going to get confused, guarantee it. Okay. So the Act requires an owner of one or more residential properties in Canada, unless you fall under a category of excluded owners. And we'll look at the definition of what's an excluded owner. So if you're not an excluded owner, then you're required, if you own residential property as of December 31st in the previous calendar year, so in this case 2022, to do the filing for each of those properties. You have to file an annual return. So we got to look at what some of these definitions are in the categories. So the first one is who is considered to be an owner. Okay, so an owner under this act of a residential property is whoever's the registered owner of the property and not the beneficial owner of the property. So just to explain the difference between a registered owner and a beneficial owner, I can be the registered owner, title to the property can be registered under my name, but and if you searched title, you would see I own this property, but the facts might be that I'm holding this property in trust for somebody else. Okay, there might be a trust agreement and I'm just the trustee owner, and somebody else is the real owner, and that real owner is the beneficial owner. But for the purposes of this act, because I'm registered on title, then I have the obligation to do the filing and either pay the tax or not pay the tax, because I may not have to, but in either way, I have to do the filing. It's not the beneficial owner. So if I'm holding the title in trust for Sabiha, Sabiha doesn't have to file this, but I have to file it. And part of my filing will say that I'm holding it in trust for Sabiha, but I have the obligation to do the filing because I'm the registered owner. I'm on registered title. Okay. So an owner of a residential property includes the following: the registered owner that we were just talking about, the registered owner of the property in the land registration system, a person who can reasonably be considered to be an owner of the property based on the registration system, someone that might have a life tenant under a life estate in the property. And these are rarer things, but I'm just including them here because it's in the act, and a life lease holder of the property, and a lessee is a tenant that has continuous possession of the land on which the property is situated under a long-term lease. Okay, so any of these things, you've got to look at everybody's particular fact situation to see if anybody falls under any of these definitions of an owner. And if they are an owner, then they're one that's subject to this act. So that who is an owner. Now they have another category of who is an excluded owner. So
David, can I ask a dumb question? If you go back to the last slide,
yeah,
the last point on the last slide,
a
what would
lessee.
that, yeah, what is that? Like for a condo owner, I guess, or
Well, if there's a long-term lease of a property,
would that
um,
would that be
it's
considered the
usually more like
condominium?
a land lease or a different type of lease. Not usually, but if it's a long-term lease, and I don't even know if they have a definition in the regulations yet of what a long-term lease is, but then they may have an obligation to file as well.
So, I mean, for instance, like a
But usually in
condominium,
residential properties, it's the owner of the property that be filing it, not the tenant.
right?
Okay.
What I was saying is that, do you think that the condominium would fall into that category because the land is
Not usually, unless there's some unusually long-term lease. And I don't know if the regulations come out to define exactly what they mean by a long-term lease. Okay, it really, they're looking at someone that has a leasehold interest in a property as opposed to a freehold interest, but under a long-term lease.
okay?
Okay.
Fair enough. Yeah.
All right. So let's look at who is an excluded owner. So an individual who's a Canadian citizen or permanent residence, unless they're included in a different definition that I'm going to get to in a minute, called an affected owner. Okay, so there's owners, there's excluded owners. There's going to be another definition of an affected owner that we're going to look at in a minute. So an excluded owner is a Canadian citizen or permanent resident unless they fall under the category of an affected owner. Another category of excluded owner is any person, including an individual as a Canadian citizen or PR, that owns a residential property as a trustee of a mutual fund trust, a REIT, a real estate investment trust, or a specified investment flow-through trust for Canadian tax purposes. So there's a category of those type of trustee holders. The next one is a Canadian corporation whose shares are listed on a stock exchange, a registered charity, a cooperative housing corporation, or an Indigenous governing body or a corporation owned by an Indigenous governing body. So they are all excluded from this if they fit under one of those categories. Okay. Now, the next category or definition that we have to look at is an affected owner. So these are owners that do not fall under the definition of excluded owners, so they are considered to be affected owners. Okay, so and their affected owners include an individual who's not a Canadian citizen or permanent resident, an individual who is a Canadian citizen or permanent resident and owns residential property as a trustee, okay, of a trust, other than a personal representative of a deceased individual. So what that means is it's someone who is a trustee. That example I gave, if I was the registered owner of the property, I was just holding the property in trust for Sabiha, okay, so I would be an affected owner. Now, if I was holding the property in trust because I was the executor of somebody's estate, so I'm the personal representative of a deceased individual, then I would not be affected owner, even though I'm still acting as a trustee in that capacity. I would not be an affected owner. But if I'm just holding a property in trust for somebody else or for another entity, then I am considered an affected owner. The next category is any person, including an individual who's a Canadian citizen or PR, that owns a residential property as a partner of a partnership. Okay, so your first question, well, if there's a few partners, does each one have to file? And the answer appears to be yes. Same thing, if there was more than one trustee, each trustee has to file that they are a trustee holder of a property. Okay, they would become an affected owner. A corporation that is incorporated outside of Canada is an affected owner. A corporation whose shares are not listed on a Canadian stock exchange is an affected owner. So what that means is if it's a private corporation, if it's a Canadian private corporation, somebody's holding corporation, it could be your PREC, it could be any holding corporation that shares are privately held, would be an affected owner, okay? And a corporation without share capital is also considered an affected owner. So before we go on, we got to look, well, what's included as a residential property? Because you saw that kept coming in, someone that owns residential property. So there's a definition of residential property under this act too, and it includes a detached or similar building containing not more than 3 dwelling units. Okay, so if it's more than 3 dwelling units, even though it's residential, it wouldn't be considered residential for the purposes of this act, where we'd be subject to the filing under this act. Okay, a semi-detached house, a row house, a condo is considered a residential property under this act. Okay, so the 3 dwelling units is the key takeaway here. That's the maximum. So if it's a 6-plex, it wouldn't, even though it's all residential, it doesn't come under this act. Okay, and then they define further like what's really considered a dwelling unit, and it's got to have a private kitchen facility, it's got to have a bath, private living area, and then you give examples of residential property of detached houses, duplexes, residential condos. Something that non-residential examples would be quadruplexes, hotels, high-rise apartment buildings. They would all not fall under this definition of a residential property. So now we've looked at some of those definitions. Let's look at filing and payment requirements. So the first point, if someone falls under the definition of an excluded owner, you have no obligation under the act. Okay, you're not going to be subject to this. An affected owner, however, has to file this form. Okay, this form UHT 2900. Now, this will be done by the accountant, by whoever's doing the tax return, as part of their normal course filing of their person's income taxes, which is done usually by April 30th of each year. So usually it'd be done as part of that. It's just an additional add-on, additional form that has to be filed. In this case, because of the recent announcement, the accountants don't have to get this filed by April 30th because they've now got, they don't have to file this form until the end of October of this year. You still have to file your normal income taxes by April 30th. Like nothing's changed for that. But this particular form for this year only can be filed up until the end of October. Other than this year, it's going to be something that has to be filed by April 30th every year. So it's affected owners that have to file this return. Okay. Now the tax is payable for each of the properties for which all of the following conditions are met as of December 31st of a particular calendar year. So again, when they do this filing, you look year over year. Every year is a new consideration. So this first time, we're only looking at the year 2022, and it's what was the fact situation in existence for this particular residential property as of December 31st, 2022. Okay, was the property a residential property? Did it fit under those definitions? Was the owner of that property not an excluded owner? Because if they're excluded, they don't have an obligation. So if they're not excluded owner, then you keep going. If the ownership of the property doesn't fall under one or more exemptions that might be in the act. And then the tax return for the calendar year has to be filed, as I said, usually by April 30th of the following year, with the one exception for this year, because it was extended to October 31st. Okay. And the tax for calendar year, if it's payable, if there is tax payable, it has to be paid by April 30th as well. So it's two separate things. The tax return has to be filed. And if there is tax payable, it has to be paid by April 30th. Now, in some instances, the tax return has to be filed and there's no tax payable. In other situations, the tax return has to be filed and there is tax payable. And if so, the tax itself has to be paid by April 30th to avoid penalties and interest on it. Now, there are certain exemptions, okay? So we've got excluded owners don't pay anything. Affected owners have to do the filing if they fit the definition of residential property and they're not excluded. But there are other exemptions available as well. So I want to just show you what the exemptions are. There's 4 different categories of exemptions. So far, someone might have to pay everything to do it, but they might fall under one of these exemptions that gets them out of paying. So these, and I'll run through each of these, but these are the 4 categories of exemptions. There's the type of owner, the availability of the residential property, the location and use of the property, and whoever the occupant of the property is. So depending if you fit certain categories, there might be an exemption available as well. So the first exemption is the type of an owner. Okay, so an owner of a residential property might be exempt in a particular calendar year. And again, I'm repeating myself, but you look at this every single year when you're doing the following. So in 2022, their fact situation might be one way. In 2023, it might be different. In 2024, it might be different. So look at it each year. So in the owner, they might be exempt for a calendar year, for the 2022 calendar year, if that owner was a new owner. They just became the owner during that calendar year, and they weren't an owner of the prior 9 calendar years. So if they were a brand new owner, they could be exempt. They just bought this property during 2022. They weren't the owner prior, so they're exempt for the year 2022. Eventually, they won't fit under this exemption anymore. Deceased owners, the second category. If the owner died during 2022 or the prior calendar year, or the co-owner or personal representative of the deceased owner. So there might be an exemption for someone who deceased during that calendar year. A specified Canadian corporation, there's an exemption. If a Canadian corporation were less than 10% of the voting shares and the equity value are owned by non-Canadians in the calendar year. So maybe the fact situation fits that. If the next exemption is a partner of a specified Canadian partnership. So a partnership, each member of which is an excluded owner of a specified Canadian corporation or a trustee of a specified Canadian trust. And I know this is very complicated. And the point is, don't try and understand every word of this right now. It's impossible. You got to look at every fact situation all the time to see if somebody's particular facts fits under any of these exemptions for that particular year. Okay, so that's the first category of exemption. The second category of exemption is the availability of the property, which is sort of interesting. So this is It's a residential property, but it might be exempt in a particular calendar year if it's seasonally inhabitable, like it's not suitable for year-round use as a place of residence. So if the facts of that particular property fit that it's not suitable, and you can justify that, then there's an exemption available. If it's seasonally inaccessible, same thing. There might not be access to it year-round. It might be a property you can only get to by water. You can't get there in the winter. It might be a property that's not, in the winter months, it's not plowed. There's no way to get to it. So there might be an exemption depending on the actual fact situations that would be justified to the government if necessary by what the situation is. There might be an exemption there because the property is not available. The third one here is that it's under renovation or construction. So if the property's not substantially, the renovation or construction is not substantially complete before April of the calendar year, or the property was constructed the first quarter of the year and it's offered for sale to the public during the year, or the property under renovation for a period of at least 120 consecutive days in the calendar year. So again, got to look at each fact situation on its own, see if it fits any of these exemptions. And the last one under this category is a disaster or hazardous condition where the property is uninhabitable for a period of at least 60 consecutive days in the calendar year due to a natural disaster or hazardous condition. So again, very limited exemption, but in certain circumstances, that might be available as an exemption, okay, for the tax. So that's the second category. The third category exemption is dependent on the location and use of the property. So a property might be exempt in a particular calendar year if it's a vacation property, if it's located in an eligible area of Canada and used by the owner and or the owner's spouse or common law partner for at least 28 days in the calendar year. And the CRA has developed a tool. There's fine print in the bottom here, and I hope you could read it. A tool for determining whether a property is located in what they consider to be an eligible area of Canada. So there's a website that you can go on to, and it shows you, and you can determine whether or not the particular vacation property is actually located in an eligible part of the country, in which case there is an exemption available. Okay, and remember, this is federal. This is Canada wide. It's not, well, what about this part of Ontario or this part of the, cottage countries? Maybe you got to look on that tool and see what they consider to be eligible, because there's certain parts that are eligible, certain parts that aren't eligible under this exemption. Okay, so it's got to be eligible based on, you could use this tool, and then it's got to fit the rest of the definition that it's used for at least 28 days in a calendar year. Okay, and again, it's year by year where you're looking at this and trying to see if it fits any of these exemptions. And the last category exemption, it really depends on who's occupying the property. So there could be an exemption available if it is a primary place of residence of the individual owner, their spouse or common law partner, or the child, while the child is a student. Okay, so that's the most common type of exemption that people would have, because it's their primary place of residence. They're actually living there. And again, all of this would have to be supported by true facts, because you're doing real filings and certifying that these filings are true, etc. The other is if the property is occupied for a period of at least 180 days in a calendar year, and it doesn't say consecutive days, but it's 180 days in a calendar year. So it's basically half the calendar year. Okay. And it's year by year. So in 2022, was it occupied for at least 180 days in the year 2022 by an arm's length individual under a lease? Okay. And arm's length means it's not to your spouse or to your child or something like that. It's to a third party, a real bona fide third party. Or it could be to a non-arm's length individual under a lease if they're actually paying rent. So if you are leasing it out to one of your adult children or somebody is, but they're actually paying rent, then it could fit under this exemption. It's got to be fair rent. You'd have to justify it, and it's got to be a lease and a written lease, and you'd have to be able to produce it when asked. Or it could be occupied by an individual who's the owner or the owner's spouse or common law partner who has a Canadian work permit. Okay. Or it could be occupied by a Canadian citizen or PR who is the spouse, common law partner, parent, or child of the owner. Okay. So this whole category of exemption is all determined based on who's actually using the property, who's living there. Okay. And if it's their primary place of residence, it's easier. If it's occupied under one of those other categories, it's got to be for at least 180 days. So you got to see if it fits any of those occupation definitions, but you also got to count the number of days in the year 2022 to see if you qualify for that exemption as well. Now, non-Canadian owners of multiple residential properties. There's a special rule that applies if an individual who is not a Canadian citizen or a permanent resident, together with their spouse or common law partner, who also is not a Canadian citizen or a permanent resident, they own multiple residential properties. Okay, and based on this rule, the tax may be payable on all of the properties except for one in which they make an election to designate it as either a primary, as their primary residence, or to occupy by an individual that would qualify as an occupant on the previous slide that I showed you. So if they own 4 properties and they're non-residents, non-permanent residents, non-Canadian citizens, they pay the tax on 3 of them, and one of them they can designate if it's their principal resident or if it's occupied by a qualified occupant based on that that exemption definition of who can occupy. So they're allowed 1 exemption that way if they own multi-properties. So now the question you're all asking, okay, if we have to pay this tax, or if certain people have to pay this tax, exactly what is the tax? What are they paying? So the tax is based on 1% of the taxable value of the property. Okay. So if more than one party owns the property, the tax will be payable in proportion to their ownership percentage. So if 4 people own the property together and they're all subject to the tax and they own it 25% each, and the property is worth $1 million, so each one would have an obligation based on their 25% ownership. So they would each be paying 1% on their $250,000 interest in that property. Okay, it's 1% of the taxable value of the property. Now, how do you determine the taxable value of the property? So they defined that as being the greater of the property's assessed value, like a municipal property tax assessment. So that assessed value, or the property's most recent sale price on or before December 31 of the calendar year. Okay, so whichever is greater. So if the assessed value is less than the price that property sold for, then it's going to be the higher price. So whatever's higher, it is going to be deemed to be the taxable value of the property, and you pay 1% on the taxable value of the property. Now, the owner may elect to use the fair market value of the property at any time after January 1 of the calendar year and on or before April 30 of the following year. Okay. And it's basically 1% times either the taxable value or the fair market value times whatever their ownership percentage is. Okay. So if it was $1 million value and they had a 25% interest, they're going to pay 1%. Each owner is going to pay 1% of that value. So it'll be it's a total $10,000 tax on $1 million property. if four owners each have a 25% interest, then each owner be paying $2,500. If somebody owned it all by themselves and it was $1 million, they'd be paying a $10,000 tax. And this is annually. Okay. Next year, they're going to file their tax return again, go through this process. And if there's no exemption for them, and they're considered an owner and they're an affected owner and they don't fit under a category exemption, then the following year they'll pay a $10,000 tax again, or maybe the value of the property's gone up to $1.1 million and they're now going to be paying $11,000 tax that year. Okay, so it's not a one-time thing, it's an annual thing. You're going to pay this tax every year unless there's an exemption available to you. And again, I'm repeating myself, just because there's an exemption in one year, there may not be an exemption the following year, or if there was no exemption one year and it was payable, maybe there will be an exemption the following year. It depends on the fact situations, how the property is being used, how it's being occupied, who owns it, etc., and whether they fit under any of these categories. So what happens if you don't pay it, or you don't pay it on time? The government's established penalties. So a couple different categories here, and this is very important for all of us. So owners who are obligated to file a return, but they fail to file the return, are subject to a minimum penalty of $5,000 for an individual and $10,000 in all other cases. So what are non-individual cases? It's a corporation, a trust, things like that. Okay. If it's an individual, it's just $5,000, $10,000 for others. And that's if you fail to file your tax return. Okay. Now, owners who fail to file the tax return, that's the minimum. Sorry, that's the minimum. The maximum is 5% of the tax payable and 3% of the tax payable by each complete month that the tax return is not filed. Okay, so this adds up pretty quickly. So the minimums are those 5,000 or 10,000, depending if it's individual or not, but the maximums really start to add up because it's 5% of the tax payable and 3% of the tax bill for each month that's late. So that's why there was a lot of panic recently about people trying to get this done before the end of April. And that's why the government realized they were getting a lot of people complaining, a lot of tax accountants, et cetera, saying like, this is all new, it's confusing, it's complicated, we can't get this done by April 30th. So that's why they gave them the reprieve this year till October, because these penalties would be extremely onerous and they're quite significant. Okay. Now, if the tax return for a calendar year is still not filed by December 31st at the end of the year, so if we were normally supposed to file by April 30th and it wasn't filed by December 31st this year, then the maximum amount of the penalties is determined as if certain exemptions were not available and the tax was otherwise payable. So what that means is if you didn't file your tax return by the end of the year, you're supposed to file it April 30th, but you didn't even file it by the end of December, even if you had no tax payable, if you would have filed it, you're going to be paying a tax as if it was payable. Even if you had an exemption and all you really had was an obligation to file the return, and you file the return, it would say no tax payable, I fit under an exemption, but you filed it that late. So the law says not only are you going to have these penalties for paying it late, but we're actually going to make you pay the tax that you otherwise wouldn't be paying just because you took so long in paying it. So it really becomes quite onerous and significant. And they've also added anti-avoidance provisions as well in here, like they do in a lot of their legislation, that could be applicable to deny a person a tax benefit resulting from avoidance. So it just gives broad powers to CRA to not give you other things that someone might otherwise have because they haven't paid their tax and they haven't done it in a timely fashion under this act. So bottom line is you got to be very careful with this thing. It's extremely confusing. You have to get a hold of your tax accountant, whoever's doing your filing, and say, hey, do I have to do any filing? Your clients, this is, a great way to touch base with your clients now that you have some knowledge of this thing, to say, hey, do you know about this act? Is your accountant aware? I know you own more than one property, or you might be subject to this act, because some of your clients, and some of you for that matter, may not have to pay the tax, but they may just have to do the filing. And the filing just confirms that there's no tax payable based on their situation. So you would hate for your clients, and I'd certainly hate for any of you to get hit with any penalties just because you weren't aware of this, or your accountant wasn't on top of this and didn't do the filing. And then for others, the tax, in fact, will have to be paid maybe for 2022 because of their ownership situation. So you certainly want them to be doing their filing and paying the tax in a timely fashion. So the good news is everybody's been given an extra 6 months to sort this out and figure it out, and you'll get it done, and everybody will get it done for the year ending 2022. And hopefully a year from now, when everybody's filing it by April 30, 2024, for the year that ended in 2023, everybody will have a better understanding of this and know what their obligations are to either file and pay tax, or file and not have to pay tax because they might fit under a category of exemption. So I know that all this is quite confusing. I know some of you are going to have questions. Some of your questions I hope to be able to answer. Some of them I may
So when
not.
are you coming back?
But I'm going to throw it back to you, Sabiha, and I don't know if anybody's on the chat, but if you don't want to ask a question here, you can certainly reach out to me privately, and I'll help you out the best I can. But the best advice I could give to you on this, because I wouldn't have the answer for a lot of your particular fact questions, is, well, what about if I own this, or what about this? Do I fit this? It's, as you can see, it's really complicated, and you got to break it all down. So anybody that's asking us for legal advice on this, I'm saying, fine, we're happy to take a retainer and try and review how title is being held, who owns it, who's the registered owner, who's the trustee owner, what your situation is. If you want to pay us a fee to look into all that, we can help. But really, it's your accountant that's got to be looking at this, and we're referring to their tax accountant. And then we will get in touch with the accountant, because there's certain supporting documents that we can access to show how title is being held. And we might be aware of certain trusts that, trust agreement to show who the beneficial owners are, or who the trustees are. So we might have access to that either in our files, or there's certain information that might be on title. So our role really as real estate lawyers is to support the tax accountant, whoever's going to be doing the filing, with whatever information might be available to us. And just to give you, one example, we act for a client who's, I guess 90-ish at this point, and maybe 10, 12, 15 years ago or something like that, she owned a residential property, a condo, and she also had a cottage property. And for estate planning purposes, she decided to transfer the property from herself to herself and her 3 adult children as joint tenants, so that upon her death, the properties will go right to her children. This is just a way to not have to pay any, to not have to probate these properties and pay a tax on the probate fees based on the value of the properties to the government. But at the same time, because they're really her properties, there was a trust agreement entered into by the 4 of them saying, yeah, title's being transferred, we're all going to own it jointly, but the intent, we're doing this to avoid paying estate tax, it's for estate planning purposes. But even though we own it jointly, we're really holding the property in trust for our mother during her lifetime. It's still her property. If she wants to sell it, we'll sign whatever we have to sign to sell it. If she wants to mortgage it, we'll sign whatever we have to sign to mortgage it. She's still controlling it. So even though we're on as joint tenants with right of survivorship, we're really acting as trustee owners of this property. So under this act, all 4 people have to file. There won't be any tax payable, Canadian citizens, everybody. So there won't be any tax payable ultimately, but everybody has to file the tax return. Okay, so the accountant's got to prepare the tax return. Each one goes to their own accountant. Each one has to prepare a tax return saying, well, the owner saying, yeah, I own more than one residential property. I own my condo, I own my cottage, but I own it jointly with my daughters. Here and here's the and my role was I had to give evidence of this to the accountant. I had to give them a copy of the deed and the title search showing that the four are on as registered owners, the date they all went on as registered owners because it's part of filing this return, and then here's a copy of the trust agreement to say no, here's they're really trustees. So the daughters are trustees, but because they're trustees, they still have to file the underused housing tax return as well. That just states that we are trustees and there's no tax payable. We're trustee owners, and fill out the form and explain the date and how we became trustees and blah blah blah. At the end of the day, there's no tax obligation, but there is a filing obligation to do that, and that's going to go on year after year. So there is a cost because the accountant's charging something extra to do that filing every year. So that's one of the things, this legislation, the government's trying to collect some additional taxes from a relatively small group of people that'll actually have to pay the tax, but they've imposed this burden of filing on a huge population, and everybody's got to pay their accountant and go through this process, and sometimes pay a lawyer too to help to provide the supporting documents to show that the tax isn't payable. So that's why I never liked these, it's my political opinion again, I never liked these type of laws because they affect so many people when they're really targeting a very small group. So anyways, I hope I haven't confused you too much. And Sabiha, I'm going to throw it back to you and see if there's any
Sure. So
questions.
thank you so much, David. Yeah, complicated subject, lots of new things being introduced left, right, and center towards us, and just keeping ourselves on top of them is a challenge. Philip had, I think, added to our first initial comment about the leased land, and he's talking about pottle, which is correct. Like he says we run into long-term leases with leased land properties like trailer parks and adult communities.
Right.
Also, I think the condominium buildings are built on land that's leased, so that would be another one. Tara has said so they do not have to pay the tax on each property, excluded owners. I mean, I'm not sure when that came in. So, um,
Yeah, you have to look at each property's facts on its own. So if someone owns more than one property, you have to look at the fact situation on each one to see if there's an exemption available for that particular property. Okay. And if it is, someone that's not a Canadian citizen, not a permanent resident owning a bunch, the rule is the tax will be payable on all their properties unless they can designate one if it happens to be their principal residence and the facts support that it's their principal residence, or it's occupied by someone under the definition of who's a permitted occupant, but otherwise it would be payable on all the properties.
Yeah. Also, Devani is asking for a PDF copy of this, but Devani, I would also advise you what David said is that don't try to advise your clients on this. Just be in the know that this is there, and when in doubt, ask somebody who is well versed and actually an accountant.
That's the best advice that
Yeah,
all of us, and that's what the same advice
anything.
I'm giving to people. Talk to your tax account, and the tax accounts are, it's new to them too, right? So they've been now, the good ones have really been dealing with this, not just trying to file returns now because they knew this was coming, right? It was past 15, 16, it became in effect 16 months ago already. It's just this is the first time they're actually doing the filing and going through the form and completing it. And now some of them are scrambling, saying, hey, we don't have all the information. Is there a trust? We need a copy of the trust agreement. Send us a search of the title, send us a copy of the deed, who owns it, blah, blah, blah. So there's a lot of work to be done, especially now because it's the first time. But the best advice any of us can give them is talk to your tax accountant, right? And then the tax accountant might need some support from a real estate lawyer like me or our firm to do a search or to, get a copy of the deed, see when it was transferred, find out, whether it was something was held in trust or things like that to support it. But the tax accountant's going to be asking all those questions to try and see if there is an exemption available based on the facts. Don't try and do it yourself.
Yeah. Yeah. Any more questions? If anybody does, they can unmute and ask. Otherwise, yeah, thank you once again, David.
Okay, thank you. And what now, everybody, we could take a poll, but was I right or is Sabiha right? Was this an interesting topic or it's a pain in the what topic? Like
But a topic yet that we should discuss and we should know about for sure.
Well, look, the one thing that I'm really happy about in doing this today, and we set this up not very long ago, we were looking for a date, and I said to Sabiha, no, we got to do this one soon. We can't wait till the end of April because the filing has got to be done by April 30th. So like today was the first sort of available date where I could do this. And I thought, okay, at least we get it done on the 17th. You got 2 weeks to scramble and tell your clients and everything. So the good news is that we all got this reprieve, and the government, gave everybody an extra 6 months, because otherwise that's exactly what everybody be doing. They'd be getting off this and yelling at their accountants and telling all their clients, potential clients, you better look into this right away. So you should still do that, but at least they've got 6 months to deal with it.
Tariff put down, but essentially if you are a PR or Canadian citizen, not applicable.
For the most part, not applicable, but there are situations where it is applicable, and it's more applicable on the filing side than the actual tax payable side, but you still have to go through it. Like that example I just gave with the mother and creating a trust, so and adding her 3 daughters to title. They're Canadian citizens, all of them, but they have to file the tax return. There won't be tax payable ultimately because they'll fit under an exemption, but they have to file the tax return or they can be subject to penalties.
Also, we had only one vote, David, and it's for me, where it says it is interesting. Just saying. Thank you, everybody, for joining. We're going to see all of you soon. Thanks, David. We have to stop meeting
pleasure.
like this. This is twice in the day. So
yeah, that's a good day for me.
All right, bye-bye.
I don't know why you're complaining.